Okay, so let's start the solution. Okay, first of all, I will state the five type of accounts we do have throughout the accounting as a subject. Okay, so what are the assets? These are the recoverable amounts, plus cash, plus inventory. Okay, the let's say suppose you are into business of selling video games to customers, or you are into business of uh, selling furniture to your customers. So let's say suppose your customer says that I will pay you after a certain period of time, let's say 30 days. So that amount will become recoverable amount. Recoverable means you have to recover that amount from your customer. So that will be considered as assets. Cash, like cash balance maintained at your business entity, like which is deposited into banks also. So cash at bank also, bank accounts also will be considered as your cash. Inventory, for which from which you produce finished goods, or we can say saleable goods, which are uh, fit for selling to the customers. Apart from assets, we have liabilities. Okay, payable amounts. Let's say suppose our business is a customer for someone else, and we have to pay off them as is as a vendor, or we can say we have purchased some goods from our supplier, but we have not paid yet. So that will become our liability, because in that case we have to pay off our suppliers for the benefits we have availed of. Okay, short term, short and long term debt. Okay, this is the first, this is the second. That's a third account. Third type of accounts we have capital, the finance raised. But in case of finance raised, what type of instruments we do have to raise the finance? Equity. You can write it down so that you can revise at later point in time whenever you get time to do it. Okay, okay, let's move to here also. Okay, so next is expenses. Expenses, I think everyone will be familiar with expenses, like telephone expenses, any other any other expense, but only for business purpose, not for the personal purpose. Okay, and the last and the foremost is revenue. Sales. Okay, revenue, sales, other income, like that. So we have five type accounts, and we have also stated some of the terms which we classified as respective terms. Okay, followed by that, I'm giving you diamond rules of accounting, which will be applicable throughout the accounting as a subject. Like whenever there will be a financial transaction which involves exchange of goods and services against the money, So diamond rules of accounting will be applicable to record such financial transaction into books of accounts of the company. Okay. So first rule is, please write it down these rules for a better revision of, you know, recording the logic behind recording of journal entry. Okay. Increase in assets, expenses equals to debit. Some of you students can can reasonably raise question that why we are making it debit, why not credit. Okay, you may have certain doubts, but I am clarifying these doubts that these are the traditional methods of doing or recording journal entry. Okay, however, everyone raises this question but will be, indirectly forced to follow these methods because these are the traditional methods. It's, let's say, it's like just a science formula that there is no alternative definition to gravity, that why does gravity holds. Okay, however, in later cases, whenever we will face advanced problems, we will make uh, we will make this very very interesting through better examples, real life examples, so that it will not become, a rigorous or boring or complex method to remember and just reproducing it on the paper. Okay, I will try to make it more interesting. Increase in capital, revenue equals to credit. Equals to credit means whenever there will be increase in capital, revenue, liabilities, then we will credit the amount to the respective account. Okay, decrease in capital, revenue, liabilities will be debit to that amount. Okay, so these are the diamond rules for five type of accounts. Whenever there will be increase or decrease in the amounts. Okay, so let's move to our main solution regarding that. Okay, so which of the following account does not increase with a debit entry? Okay, so in case of accept the three choices. In case of retained earnings, it will be included in capital. Actually, what happens, what is the part of retained earnings, I'll tell you briefly. Let's say suppose you have earned profit of $10,000 during the current year. Okay, now what happens, retained earnings include different type of reserves, different type of profit, type of, special reserves as per regulatory requirements also. But the profit or loss generated during the year will be adjusted to retained earnings account. And retained earnings accounts is especially included in the capital account to reflect that the true position of financing capital in the company. So retained earnings will be included in capital. So from our diamond rules of accounting, You can see whenever there will be increase in capital, there will be a corresponding credit, not the debit. I think you got this very right. Okay, increase in capital will be a credit, not a debit. So the correct choice for the problem 30 is A. Why that so? Because the question asks that which of the following accounts will not be increased by a debit. Okay, so except the three, there will be only retained earnings which will be included in capital, and there will not be any increase by a there will be there will not be any increase in the retained earnings by the debit. There will be a reduction in the retained earnings. Okay, so correct choice for problem 30 is A. Please make sure that you have noted down these the first sheet, like five type of accounts in your notebook. Okay, followed by that you have noted diamond rules of accounting, to make sure that whenever you will face any type of difficulty in accounting, you will get your solution at first hand with this with these rules. Okay, followed by that, as a matter of relevance, we have derived our solution as correct choice as A. Okay, so that's all for the solution. Thank you.